Let's go to Washington, where the International Monetary Fund has raised its growth outlook for the US, but lowered its outlook for the European Union and China. In its latest World Economic Outlook released earlier today at the ongoing annual meetings for this year, the IMF retained its global growth outlook at 3.2%, with sub-Saharan Africa forecast to beat that figure at 4.2%. The IMF praises inflation slowdown in many regions around the world, but warns of risks around geopolitics and other headwinds. Let's listen.
Now, let me start with the good news. The battle against inflation is almost won. After peaking at 9.4% year-on-year in the third quarter of 2022, we now project headline inflation will fall to 3.5% by the end of next year. In most countries, inflation is now hovering close to central bank targets. Now, inflation came down while the global economy remained resilient. Growth is projected to hold steady at 3.2% in 2024 and 2025. The United States is expected to cool down, while other advanced economies will rebound. Performance in emerging Asia remains robust, despite a slight downward revision for China to 4.8% in 2024. Low-income countries have seen their growth revised downwards, some of it because of conflicts and climate shocks. Now, the decline in inflation without a global recession is a major achievement. Much of that disinflation can be attributed to the unwinding of the unique combination of supply and demand shocks that caused the inflation in the first place, together with improvements in labor supply due to immigration in many advanced countries. But monetary policy played a decisive role, keeping inflation expectations anchored. Now, despite the good news on inflation, risks are now tilted to the downside. These downside risks include an escalation in regional conflicts, especially in the Middle East, which could pose serious risks for commodity markets. Policy shifts toward undesirable trade and industrial policies could also significantly lower output. A sharp reduction in migration into advanced economies, which can unwind some of the supply gains that helped ease inflation in recent quarters. This could trigger an abrupt tightening of global financial conditions that would further depress output. And together, these represent about 1.6% of global output in 2026. Now, to mitigate these downside risks and to strengthen growth, policymakers now need to shift gears and implement a policy triple pivot. The first pivot on monetary policy is already underway. The decline in inflation paved the way for monetary easing across major central banks. This will support activity at a time when labor markets are showing signs of cooling with rising unemployment rates. So far, however, this rise has been gradual and does not point to an imminent slowdown. Lower interest rates in major economies will also ease the pressure on emerging market economies. However, vigilance remains key. Inflation in services remains too elevated, almost double pre-pandemic levels, and a few emerging market economies are seeing rising price pressures, calling for higher policy rates. Furthermore, we've now entered a world dominated by supply shocks from climate, health, and geopolitical tensions, and this makes the job of central banks harder. The second pivot is on fiscal policy. It is urgent to stabilize debt dynamics and rebuild much-needed fiscal buffers. For the United States and China, current fiscal plans do not stabilize debt dynamics. For other countries, despite early improvements, there are increasing signs of slippage. The path is narrow. Delaying consolidation increases the risk of disorderly adjustments, while an excessively abrupt turn towards fiscal tightening could hurt economic activity. Success requires implementing, where necessary and without delay, a sustained and credible multi-year fiscal adjustment. The third pivot, and the hardest, is toward growth-enhancing reform. This is the only way we can address many of the challenges we face. Many countries are implementing industrial and trade policy measures to protect domestic workers and industries. These measures can sometimes boost investment and activity in the short run, but they often lead to retaliation and ultimately fail to deliver sustained improvements in standards of living. They should be avoided when not carefully addressing well-identified market failures or narrowly defined national security concerns. Economic growth must come instead from ambitious domestic reforms that boost innovation, increase human capital, improve competition, and resource allocation. Growth-enhancing reforms often face significant social resistance. Our report shows that information strategies can help improve support, but they only go so far. Building trust between government and citizens and the inclusion of proper compensation measures are essential features. Building trust is an important lesson that should also resonate when thinking about ways to further improve international cooperation to address common challenges in the year that we celebrate the 80th anniversary of the Bretton Woods institutions.
All right, in the meantime, the International Monetary Fund has assured that financial stability risks are contained in the near term, but ones of economic and geopolitical uncertainties. That much was contained in the executive summary of the three-chapter latest Global Financial Stability Report released today in Washington, D.C. This is an excerpt from the presentation.
Tobias, when we released our last GFSR in April, optimism in financial markets was fueling asset valuations, credit spreads had compressed, and valuations in riskier asset markets had ratcheted up. At the time, you warned of some short-term risks like persistent inflation, as well as the tension between these narrowing credit spreads and the deteriorating underlying credit quality in some regions. But you also warned of some more medium-term risks like heightened vulnerabilities amidst elevated debt levels globally. So where are we now since then, 6 months later?
Yeah, thanks so much. And let me welcome all of you to this launch of the Global Financial Stability Report. So the themes that you highlight, Alex, have broadly continued. So let me start with inflation. So global inflation has progressed towards target in most countries. Most central banks continue with a tight stance of policy, but have started to cut rates. Now, with inflation heading towards target in many countries, the focus of the central banks has shifted from being primarily focused on inflation towards also considering real activity. And so concerning real activity, we have seen upward surprises relative to expectations. In financial markets, that has been particularly visible in earnings surprises that have been on the positive side. And so as a result, the likelihood of a global recession has continued to recede. So the baseline forecast is one of a soft landing globally. And that is the optimism that we had flagged already in April that has been reinforced in many ways, and that is fueling optimism in financial markets. So financial conditions globally continue to be accommodative, credit spreads continue to be tight, implied volatility, particularly in risk asset markets such as in equity markets, continues to be fairly low. Now, our main theme in Chapter 1, which is released today, is a tension between this financial market assessment of volatility, i.e. the implied volatility in the equity market is perhaps the best indicator here, which is at fairly low levels by historical standards, relative to measures of global geopolitical uncertainty. So in the report, we're showing two measures that are computed not at the fund, but by other institutions, one on geopolitical uncertainty, the other one on economic uncertainty, and those continue to be relatively elevated. So there's a kind of wedge in between the financial market implied volatility and the assessment of political or economic uncertainty. And so this tension worries us as it gives rise to the potential for a sharp readjustment of financial conditions. And so we saw a little bit of that in August in a sell-off that was very brief. So it's it's a blip in retrospect, but it does raise the concern whether there are some vulnerabilities in the financial system that could be triggered if adverse shocks hit.